Well, hey there, everyone. Happy Wednesday, June 11th, 2025. Welcome to Chart This with Dave Keller. I'm your host, Dave Keller, coming to you from a just absolutely beautiful Redmond, Washington, sort of highs in the low 70s. It's a beautiful, clear day, nice and green. That rainy half of the year makes it all worthwhile when we get to this point in the year, right around June. Hope you guys are all doing well, staying safe, thriving wherever you're at. And I appreciate you joining me here for a brief moment after the close as we spend some time together reviewing the charts and focusing on some of the key patterns and movements. And it's my wife's birthday today. So happy birthday, Carrie. All right. Today, choppy market, afternoon, getting kind of rough. Right around 1:30 Eastern, we'll call it. Market ends up, having a secondary peak, rotating lower. What looked like a pretty decent update earlier in the day ended up being more of a pullback sort of day. The S&P did remain above 6,000, so remaining above that key round number of support. But overall, what looked like a pretty strong open first hour was pretty consistently positive. Ended up being kind of a give back day. We'll look at the charts on the major indexes. We'll talk about how energy continues to be at the top of the leaderboard, given the strength in crude oil prices. We'll talk about how growth sectors are starting to differentiate between one another, and a lot of other charts along the way. With that in mind, let's get to the market recap. Someone noticed, by the way, I did go clean shaven, and it happened. It's a cyclical thing. Some have tried to tie my shaving strategy with the market environment. I guarantee that is not a comment that I'm making. I just honestly get sick of it, and then I shave it off, and then I get sick of shaving, and I let it grow, and that's the volatility that we have with the facial hair. All right, let's look at the major averages here. You can see, as I mentioned, the S&P strong open. Week afternoon, really from around 1:30 to 2:15 Eastern was the big drawdown. Ended up finding stability just above 6,000 and holding into the close. So the S&P closed just above 6,022. The Dow almost exactly flat for the day. It finished literally 1 point lower in an index pushing 43,000. So that was a nominal, just the tiniest change, and that's about it. The NASDAQ composite about 0.5% lower. Mid caps and small caps all down as well. The VIX moving slightly higher. We're back above 17, but still below 20. So again, I'm a fan of simplifying. I'm a fan of sort of looking at some of these gauges, these market gauges, and instead of nitpicking on day-to-day movements, just sort of look at what is the overall signal that would tell you something's different. I think the VIX above 20 is a potential cause for concern. VIX below 20, market's telling you not much to be worried about. Again, what that's doing is looking at the volatility in the S&P index options market and using that to imply volatility for the S&P itself. So the market's still saying kind of a low volatility environment here in early to mid June. Rates overall moving lower today. So yesterday, the 10-year yield, the long bond yield moved higher. Today, kind of the opposite. Bonds rallied a bit, not by much. The TLT was up about 1/3%. The dollar was down about 1/3%. Rates generally drifted lower. So the 10-year yield is just about 4.4%. 5-year point is just holding 4%, and the long bond yield around 4.9%. And it's interesting what happens coming out of the CPI data, which ended up being lower than expected, sort of saying inflation's kind of a non-issue. Market rallied immediately, but then rotated lower very, very, very quickly. All right, looking at the commodity space, you can see the DBC was up 1.6%. That's driven mostly by crude oil prices. You can see the USO, which is a crude oil ETF, was up 4.5%. Gold and silver were mixed. Gold prices up, with the GLD up about 0.5%. Silver down about 0.8%. Copper, the worst performer on this page, down 2.2%. I mean, one of the key stories out of today, besides the fact that the market didn't rally more, talking about the equity markets, didn't rally more, given the news this morning. I think it's the crude oil continuing to push to the upside. Some headlines, of course, coming out this afternoon about potential growing conflict in the Middle East. That could certainly be a part of the higher crude oil, weaker equity price theme going into the afternoon. We'll see. Looking at the cryptocurrency space, most of the top 10 coins on the stock charts platform were down today. Ethereum is slightly higher. Bitcoin, you can see over the last 24 hours, got up just above 110,000 a couple times. Each one of those advances has been repelled. So we're kind of right at those previous all-time highs. I mean, the bet I'm making in my portfolio is that we keep going a lot further to the upside. I would say, as a technical analyst, I'd feel better about that position if and when Bitcoin powers above resistance and continues to push to the upside. We're kind of knocking on the door of new all-time highs, but for now, kind of failing to get above there. Bitcoin currently trading just above 109,000. Looking at the 11 S&P sectors, we can see 4 up, 7 down. So more sectors down than up today. Energy, definitely the outlier. I mean, if you take energy off the table, this is a pretty rough day for equities. But the XLE was up 1.5% today. And again, stronger crude oil prices are a big part of that story, if not the story, to be honest with you. Utilities, healthcare, industrials, all basically flat for the day, and we'll call them tied for second place today. On the downside, materials, the worst performer, down 1%. That's the XLB. The consumer discretionary sector, the XLY, down 0.8%. REITs, number 3 from the bottom, down about 0.5%. You know, breadth was not great today, and this is one of those things that changed through the course of the day. If you looked at breadth readings out of the open, actually pretty good through the course of the day and certainly into the afternoon, things started to get ugly very, very quickly. The S&P breadth 2-to-1, stocks down versus up. You can see on the New York Stock Exchange a little more neutral, and the same with the Nasdaq Composite, not as negative, but large caps, mid caps, small caps, all the S&P indexes, worse breadth today. And I would say that's been one of the, I guess, changes of character of the market here in June. Coming out of May, we had breadth conditions get kind of weak. Over the last week or two, coming out of the end of May into the beginning of June, the breadth has actually improved quite a bit. The McClellan oscillator breaks back below the zero line. More than half of stocks above their 200-day moving average. Over 75% of the S&P above their 50-day moving average. Those are kind of bullish readings. Days like this, if you would see more and more days like this, that's where you have to start to question the sustainability of the uptrend. So an emerging theme, certainly to keep an eye on. All right, looking at the Magnificent Seven and Friends, you can see Broadcom up 3.4%. That's your best performer. The chart of Broadcom had been remarkably strong, kind of an exponential rise. It broke down below trendline support, but now here this week, sort of pushing back to the upside. We'll take a look at that chart, time permitting. Netflix up 1.4%. It's been lagging a little bit, although it's sort of testing new all-time highs. On the downside, Amazon and Apple, two kind of underwhelming charts. Apple really does not look good. That is a probably non-technical way of describing the conditions. But, going into a week like this with the Worldwide Developers Conference yesterday, I would argue there's your opportunity for Apple to just really, put aside the naysayers and justify further upside. Going into that conference, coming out of that conference, the price action has been whimpering at best and continue to roll over here. So if you're all bulled up on Apple, I would say the fact that we're deteriorating through some of these things that should be news, should be bullish catalysts for the stock that has been lagging behind the rest of the Magnificent Seven names. We're not seeing it this week so far. I do see questions coming in, by the way, on the various platforms upon which we are live streaming: YouTube, X, LinkedIn, and Facebook. I appreciate you guys tuning in live on any of those platforms. Wherever you're watching the live stream, I can see comments. Just put them below the video, and we'll try to take a question or two before the end of today's session. Any of the questions we don't get to, we will put into the mailbag. Friday, we're planning an all mailbag episode. We'd love to answer one of your questions as part of that special episode, where we have a little more time and space to answer questions more thoughtfully, more deliberately. So keep them coming. I already see a couple questions that would be great for the end of today's episode. Keep them coming, won't you? All right, let's go to the market carpet. This is a heat map style visualization showing the sort of quilt of the landscape of the S&P 500. Grouped by sector. What stands out? I mean, not a great day would be the initial thing that stands out to me. I'm seeing a lot of neutral and orangish and reddish colors, kind of salmon colors like Meta here. that are not great. Reminds me of the salmon berries. And if you don't know your berries, come live in the Pacific Northwest. I've learned a ton about them. Salmon berries are these early season berries. They look a lot like blackberries, but they're salmon color, kind of this shade, kind of a peachy, salmony kind of color. They're have bigger seeds and they're not as enjoyable, I would say, as like blackberries or huckleberries, but they grow like weeds around here and they pop up first. That's sort of a sign that conditions are getting pretty good. So when the market carpet looks like a bunch of salmon berries, not a great day. That's more of a negative day than positive. And I'm immediately drawn to some of the bright red, or certainly the concentrations of red. And if you look, you'll find a couple group themes. For example, within the consumer discretionary sector, cruise lines pulling back today. Not bad. I mean, some of these charts like CCL have been really starting to break out. Nice moves off of the April lows. But pulling back today, just over 2% for Carnival. Within the industrial sector, airlines, now charts like UAL aren't bad charts. We're sort of making higher highs and higher lows. But the problem with a move like this is we've gotten above the 200-day moving average, and the key is sustaining that breakout, right? And I think that's the bearish scenario from here involves a lot of stocks like UAL not holding their 200-day. And that can be reflected on individual charts like UAL, where you see the 200-day maybe not holding like we see today. We can see that in breadth data, right? Just look at the percent of stocks above their 200-day. And if you start to see it get closer and closer to 50% and starting to rotate below 50%, that tells you the UALs of the world are not holding the 200-day. And that's that could be kind of a concern here. So all the airlines, Southwest, Delta, United, here in the S&P breaking down a bit today. On the other side of that, though, you can see some green. I would say the energy sector, again, this has been a number of times here in the last week where we've highlighted the fact that the energy sector actually looks pretty compelling here. Now, I interviewed Rob Thummel, who's an energy portfolio manager. Well, it's been 4 or 6 weeks ago, probably, and at the time, crude oil prices, maybe making a double bottom, but still not quite clear that was the case. And most oil companies did not look particularly good. Other areas of the energy sector looked remarkably strong. Pipelines, natural gas companies, what we described as energy infrastructure plays. But now, as crude oil prices are starting to improve, we're seeing sort of the other, right? The things you normally think of as the energy sector starting to rotate higher, right? COP trying to make a new high for the last couple months. ExxonMobil breaking to a new swing high. Apache, higher highs, higher lows, and those trends are just starting to emerge here. That's going to keep working if crude oil prices continue to move to the upside, and I think that's been the big change for that sector, is the fact that crude oil prices are starting to improve. From a technical perspective, I think crude oil is a pretty compelling chart all of a sudden. So something to focus on. Within the material sector, highlighting the red in some of the steel companies. Some of these companies ripped here recently, like Nucor, like Steel Dynamics. Sorry to jump around a little bit here, but with Steel Dynamics, you had this nice move off of the April low, pull back, and then these all gapped higher. This is at the end of May. But if you look at STLD, it kind of gapped right up to the February and May peaks. And from there, that's been the tops, right? So we're seeing gaps up to resistance, but then failing. And I always say in a bull market, stocks don't trade to resistance, they trade through resistance. And I think charts like STLD are showing that that's not necessarily happening all across the board. So definitely it feels like more of a mixed bag of stocks, more individual names and themes kind of popping out here. In a sector like healthcare, most things down, but United Healthcare, CVS, McKesson having decent days. In the technology sector, which was not a particularly good day, you'll see like Palantir and IBM and Broadcom having good days. So it really was more of an opportunistic stock by stock pattern, I would say, in today's action. All right, let's go to the chart review. I've hand selected some charts through my own process of analyzing a bunch of charts through the course of the day today. Some things to share with you. If there are other charts or indicators that you'd like me to look at, please drop a comment wherever you're watching the live stream if you're tuning in live, and we'll try to grab them before the end of the episode. The daily chart of the S&P 500 overall still looks quite good. Today isn't really a candle pattern that I would highlight. We're sort of, it's not really a dark cloud cover candle, and I'll show you what I mean here. If we change the chart of the S&P 500 to a candle chart, and if we zoom in a little bit, a dark cloud cover is a 2 candle pattern where you have a big up day and a big down day, and day 2 breaks at least 50% of the way through day 1's body, the real body from open to close. It's almost exactly there, but not clearly breaking below the 50% line. So I'd have to say it's not quite a bearish candle pattern. It sort of looks like a pullback. We'll have to see what happens certainly tomorrow and Friday to see if there's further deterioration. For now, I would say, we're sort of holding that 6,000 level. Last 2-3 sessions have held right about there after Friday closed almost exactly at 6,000. So as a tactical level of support, that's certainly one that I'm looking at. More of the longer term kind of line in the sand approach that we like to advocate. I think we're in a green light above 5,800, 5,750. I think we're in a yellow light below that, but still above 5,500. And I think below 5,500, it's a big red light. And if you want to know how I would be positioned through that period, green light, I'm kind of going risk on and I'm trying to own things that are going up. A yellow light, I'm probably taking some bets off and going with more balanced allocation. Red light below 5,500, I'm getting pretty defensive, going to cash and cash-like things and hard assets and trying to ride things out. So for now, market's in good shape. Potential divergence, I think this may be one of the more important charts to watch here over the next couple sessions, because if we would drop tomorrow, if we would continue to go lower on Friday, what that would do is sort of create a very clear higher high in prices, right? If this ends up being a peak today, and if this ends up being the high for the week, and we sort of have a very clear pullback, what that would mean is it would validate a bearish momentum divergence on the S&P 500. And if you look back in history, those divergences are pretty meaningful. Someone mentioned watching the video that I did on divergences that was on Stock Charts TV. I put that out yesterday. Hope you will watch that. I do a weekly show on Stock Charts TV. We talked all about divergences, why markets moving higher on weaker momentum is something to be concerned about. We looked at some previous examples of where market peaks, sort of lined up very, very well with those divergent signals. We may be getting one now, but you have to wait for the market to pull back enough to confirm that this was a higher high on weaker momentum. But if this would be the high today, there would be a very clear bearish momentum divergence, suggesting to me a pullback at least to the 200-day around 5,800. So I think the remainder of this week could be pretty crucial. Talked a lot with my guest, George Noble. That podcast episode just went out before I started the show. I actually started the show a couple minutes late just to make sure that was loaded on the different platforms okay, which it is. So you can find that latest episode of the Market Misbehavior podcast on my YouTube channel. We're on all the podcast platforms now as well. So Spotify, Apple Podcasts, etc. And George Noble, if you don't know, a legendary investor. He was an intern with Peter Lynch in 1981. He was given responsibility for the Fidelity Overseas Fund a couple years later in 1984, and ended up having an incredible run from like 84 to 87. And we talked about those early successes. We talked about how he struggled through the 87 crash, talked about the challenges of looking at non-U.S. markets as a U.S.-based investor, and how to handle humility, how to handle wins, how to handle losses, and everything in between. Great investor with some fantastic anecdotes and lessons learned along the way. So make sure you check that out. We talked when we got to the end about the current market environment. He shared some of the takeaways from his investment conference that he just did last week as a virtual conference. We helped promote that event on the show here. And he had some great takeaways. We talked a lot about interest rates, though, right? And about the bond markets, and how he agreed. One of the things that I've sort of shared, I know, a number of times, which is it's often helpful to look at the bond markets first, right? And as an equity investor, you really have to acknowledge the fact that the bond markets tend to lead the equity markets in terms of major shifts. I would argue, in my own anecdotal experiences, that's because bond investors tend to be really focused on risks. Equity investors tend to be way more focused on returns, right? we're both hopefully focused on both. But I think bond investors, right? You make money, and your success based on your ability to determine how well companies are going to be able to repay their debt, how well governments are going to be able to meet their debt obligation, what huge deficits might mean, and the bond markets have a really good way of highlighting risks that won't be reflected yet on balance sheets and income statements, which is why equities don't pick them up as quickly. Rates are coming down, and that happened today, right? We had what's called a bearish engulfing pattern between yesterday and today on the chart of the 10-year yield. Maybe we're at a period where bonds start to rally here. Do we get a risk-off move in equities that coincides with bonds rallying and a pullback in rates? Maybe. For now, from a technical perspective, I'm seeing the 10-year yield break back down below trend line support off of the April low. I think that's something to watch. Now, while we're watching that, we are seeing the dollar not really rally in any meaningful way. The dollar seems continuing to trend lower, which the implication there is that non-U.S. investors don't seem to be rotating into U.S. Dollars very aggressively at this particular moment, which is maybe a concern, right? Because I think historical market rallies in previous years have been driven in no small part based on a lot of non-U.S. investors putting money into U.S. assets. The dollar should be a lot stronger if that's exactly what we were seeing here. Gold is essentially flat, right around $3,300 an ounce. That's where we were in mid-April. That's where we are today. So the only of these three that is really starting to break out is crude oil prices. This is why the energy sector on a relative basis starting to look more and more compelling. This is why the energy sector in the form of the XLE starting to break above resistance. It's because crude oil is double bottomed and breaking above $65 a barrel. Let's keep an eye on crude oil prices. And if you've been ignoring energy because of weaker crude oil prices, two things I would tell you. I don't blame you for doing so because it's not been a great chart, but I would blame you for ignoring it now, given the fact that crude oil is starting to improve on a technical basis to a pretty decent degree. Looking at the growth sectors, this is a chart or a version of a chart that I have on my Market Misbehavior live chart list. That's a set of charts that I manage and keep updated on the Stock Charts platform. There's a set of charts that look at the three baskets of S&P sectors. Defensive sectors like utilities and consumer staples, value or cyclical sectors like financials and energy, and then growth sectors. And those are the three that I'm showing you. These are the relative performance of the technology sector, the communication services sector, the consumer discretionary sector. From mid-May to now mid-June, which of these three impresses you the most? And I hope you would agree it's the technology sector, right? Although you did have a brief pullback from early May to late May, overall the relative strength has been pretty positive. And certainly in the last couple of weeks, we're seeing technology outperform now in the month of June. You're seeing communication services outperform here in the last couple of weeks, but overall, the XLC has not really gotten you much relative to the S&P 500 itself. It's been flat on a relative basis over that period. Consumer discretionary starting to roll over. A big part of that is Tesla, getting hit. Amazon, not one of the strongest Magnificent Seven stocks. I saw someone asking about that in the chat. Would agree. Amazon's probably one of the more underwhelming Magnificent Seven charts, which leaves technology as the outlier. Seeing semiconductors work, you're seeing a bunch of other names work within the technology sector as well. Let's focus in on the chart of Amazon. You could probably label this an evening star candle pattern. It's not a perfect one. Ideally for me, there's a big gap between this little middle candle. A classic evening star candle would be a 3-candle pattern with a big up day, kind of a gap up to a little candle, and then a gap down to a big down day. And the idea is it's kind of like a bearish engulfing pattern with a little candle in the middle, kind of wedged in the middle there. So I don't know if it's a perfect textbook example, but it's pretty close enough for me, I would say. And so what's happened in the last 3 days, Amazon traded higher. Yesterday is what you'd call I'm blanking. A hanging man candle is what we would call that, right? Sort of a hammer, but it's happening up at a peak call that a hanging man. Think of that as like the head and the body hanging down. It's kind of a dark illustration, but that's what it's called. And then you have the third day, which is a big down day. So if you didn't have that day in the middle, this would be a bearish engulfing pattern with an up day and a down day. If you have this guy wedged in the middle toward the upper end, ideally a gap up to that, call that an evening star candle pattern. It's a 3-bar candle candle pattern that tells you short-term sentiment is negative. So Amazon pulling back down over 2% today. Not much of a divergence, right? So if you look at the high in May and then the high this week, it's on stronger momentum. So there's no real bearish divergence, which would be a big warning sign right about now. But definitely today's move suggests short-term weakness through the remainder of this week. And I would say with charts like this, it's a good chart. It's a good chart, if not a great chart, above the 200-day moving average. Below the 200-day moving average, it's not a great chart anymore. It's arguably not a good chart anymore, but it's certainly one I would be concerned about. The last pullback to the 200-day, as with other examples, held very, very well. We'll see if that plays out again and if that level will hold. I mean, talk about a not great week so far for Apple. You know, with as I was looking at the kind of key macro events coming up this week, the inflation data this week, consumer sentiment on Friday, all top of mind. But then the WWDC, right, the big Apple Developers Conference, where they've done things like announce the iPhone, announce all sorts of life-changing technology and everything. This week was kind of a nothing burger. Talked about AI, talked about new interfaces and stuff. That's all. It's not bad, and there were plenty of things to talk about. But there weren't those big, oh my gosh, it's an iPad kind of announcements that have, in history, sort of launched Apple to the next big bull case. Investors not really optimistic on Apple post-conference, kind of selling off today, down about the same as Amazon. What gets me about Apple, though, is look at the relative performance of Apple in 2025. So if you bought Apple at the end of last year and thought of that as one of your key holdings in 2025, you've had almost 6 months of underperforming the S&P in a pretty big way. Underperforming on the way down into the April low, underperforming since the April low. It's kind of bad offense and bad defense. It's not working in a down tape. It's not working in an up tape generally. And so it's been kind of struggling. There've been these little periods where it's outperformed on a limited period of time, but the general trend has been underperformance. And I think that's the most concerning part of the chart of Apple. And that's why I have the relative strength at the bottom of all of my charts for stocks and ETFs, because it helps you understand those particular nuances of relative strength. A couple more charts here, then we'll take some questions. DocuSign, one of my premium members asked me about this chart, and basically, the way I would summarize the question is, what did I miss? Because I bought it here, and I'm making up the question, but it was a question about nuances. But let's assume, hypothetical, I bought here, felt really good for one day, and then all of a sudden we gapped down. Like, what did I miss? I don't honestly know if you missed a whole lot. I wouldn't blame you for buying this kind of breakout. What looked compelling here? We broke above resistance. Looks almost like a cup and handle, chart's not a perfect example, but, breaking above an established resistance level. The RSI was constructive in mid-May. Relative strength, making a new, 3-month high. That's all positive. What did you miss at this moment? Right? What did not look great at this moment? I mean, a divergence, potentially, but pretty tough to say at that particular day that was going to be much of a divergence, because it was still kind of going up, right? You had one day where it was a brief pullback, which you probably would call that a dark cloud cover candle, right? Where you have an up day and a down day, and day two gets at least 50% of the way down through day one, but that's a short-term thing. I don't know if there were big warning signals right about there that were flashing. I think it's a great reminder, as much as I would love to tell you that all the tools and techniques we use in our work and that I share with you on the show, that they always work. And it's so funny when I share a tool or a technique or an indicator, someone will ask about one example where it didn't work and say, well, what about this one? And my answer is, it didn't work that time, right? Things that work a lot in the technical and fundamental toolkit, there are plenty of times where it's not going to work. And if you're assuming it's going to work all the time, you're going to be sorely disappointed. It's like going into trading, assuming that every trade you make is going to be a good one, right? Sometimes it's not about the work you put into it. It's about what the market does after all of that work is done. And when it works, you want to stay right. You want to remain in that position as long as it's justified. When it doesn't work, you need to get out of it. So DocuSign gapped lower. I think that's a bit of a downside surprise. Would I be caught on the wrong side of that? I didn't trade DocuSign in this particular example, but I probably would have. I would not have been surprised to be caught on the wrong side of that. That's why we have money management techniques. That's why when we break the line in the sand, which for me would probably be an initial stop at the breakout level, probably a secondary stop at the May swing lows. In one day, we undercut both of those. I'm out, right? I'd be out and I'd be looking for another opportunity. And the goal is you're going to have things like that to play out. The idea is sometimes this is really going to work. And that's when you want to stick with it as long as possible. When it doesn't work, admit you're wrong and get out of the way. And that's a tough thing for investors to do and for traders to do, is basically just have in one day feel like you did all this work and then it didn't work out. But I think that the sooner you can get comfortable with admitting you're wrong and taking action, the better you're going to survive and thrive through challenging periods as a trader. Let's highlight some stocks breaking out here. Franklin Resources. I've talked about some of the weakness in the financial sector. The XLF, the relative performance has not been great, but there are some stocks that are actually holding up very, very well. Franklin Resources, BEN, is one of the biggest gainers in the financial sector today, up just over 3%. And I would argue potentially breaking out of this consolidation, probably call this a bull flag pattern and a breakout today. I would love to see follow through tomorrow to confirm that breakout. Starbucks, a local company here in the Seattle area, breaking back above its 200-day moving average. Starbucks gapped below the 200-day. That was on the initial tariff tantrum here in early April, going into a low on April 7th for the S&P. Starbucks made a secondary low in late April and then started to rally, broke above the 50-day, and then now today finally getting back above the 200-day moving average. I always say that, I always quote Paul Tudor Jones, nothing good happens below the 200-day. So when something like that happens, I'm pretty happy waiting for a move back above the 200-day to validate a more constructive tape. Now I think you need to consider it. Let's look to see if there's follow through tomorrow. All right, let's answer some questions. Boy, a lot of comments on the different platforms here. So I'm going to try to select a question or two. Right angle triangle. It's such a great handle. Well done on that. Rotation trade XLK to XLE XLV. Maybe, right? Maybe. it might be too early to say. And the leg on that I'm not as much of a fan of. I don't know if I would group the XLV and XLE together. Maybe. I mean, if you look at the XLV, we're regaining the 50-day for the first time since March. That's not bad. If you look at the energy sector, maybe a little more developed in that it's made some clear higher lows. The RSI pushing above 60 this week. Healthcare is a little earlier on, right, where we're just getting above the 50-day. The RSI is still below 60. So sort of my threshold of this is no longer an underwhelming chart starts to look more impressive. We're getting close. I think what is interesting on the chart of the XLV is this bullish divergence, right? The opposite of what we talked about with charts earlier in this episode, right? Lower lows April into May on higher momentum. I think that's encouraging. On the energy sector, really didn't get any sort of divergence at the lows. We just kind of rallied. But I would love to see it continue to go higher on stronger momentum. The other thing I would say, you're not really seeing a rotation out of technology yet. Is that something we could see for sure? And I would say, if energy and we'll put healthcare in there, if they do continue to work, what happens is if you're going to rotate there, right? If you're a money manager, let's say you run a $10 billion fund and you're fully invested in U.S. equities and you want to make a bet on energy or healthcare, where are you going to take those assets from, right? What are you going to sell so that you can afford and that you can reallocate into those things? Maybe technology that's had a really good run, maybe the XLK that's retesting all-time highs. Maybe, but I'm not really seeing the rotation away from technology. You are seeing rotations away from consumer discretionary. You're seeing rotations away from a lot of financials, from industrials, which we highlighted on yesterday's episode. So I think you are seeing some things rotate away. Not technology yet, though. Richard, thanks for watching as always. And you said, Dave, do you keep a trade journal and a journal that highlights your mindset and emotions? So the answer to that is yes and yes to both of those. So three answers. So one of the great benefits I have is doing this show. And I will tell you, if you don't run a live stream every day on the markets, I mean, that sounds actually kind of nice sometimes, because as much as I love doing the show, sometimes I just want to take a day off. I probably should do that more than I do. But I enjoyed a great deal, and I love talking about charts, and I love answering questions. So I'm very fortunate that one of the benefits of doing a show like this every day is every day I'm putting some thoughts out there. I'm sharing charts. I'm talking about what I'm seeing and what I think might happen next and why. So I can go back to the episode we did on April 7th, and I can see what I was telling all of you on that particular day. It is a humbling, talk about a humbling experience. Go down and check some of those things out and see what you've been saying. So my recommendation to all of you is start a blog. Even if you don't share that, it's free to set up a blog. Plenty of websites will let you do it. And just do it for your own benefit. Don't share the blog link with another human being, but just capture your own thinking and timestamp, so you can go back and see, once we realize that this was a huge major top, go back and see what you were writing about, what you were thinking about. I think that's a great lesson. Do I do a journal managing my emotions? Yeah, every day. It's right here. I write 3 pages. I did it this morning. It looks just like this. I sit down at my kitchen table before anyone else in the house is awake. I put an espresso on the table next to me, next to that journal, and I fill 3 pages with whatever's in my head. I started doing that years ago. It was inspired by a book, The Artist's Way by Julia Cameron. It's on my recommended reading list at marketmisbehavior.com. Life-changing book. Talks about, how to get the junk out of your head and unleash your creativity as a professional. That was awesome. So I do that. That's how I manage the emotions and bouncing around my head. My trading journal is over there off screen. And I do keep a trading journal. And every time I make a trade, we'll leave it here, it has 3 lines. Line number 1, what am I doing? Line number 2, why am I doing it? Line number 3, how would the market tell me I'm wrong? So what am I doing? I'm taking this position in this stock at this level. Why am I doing it? A quick, brief justification, just reminding what is the main thesis of this trade. And then the 3rd line, what would tell me I'm wrong? I find too many investors go into a traders go into take a position assuming that they're going to be right. I don't mind being confident, but overconfidence is not realizing that you might be wrong, and you actually most likely could be wrong in many cases. So I like, for at least a brief moment, assume that I'm going to be dead wrong, and what would the market tell me to validate that I was incorrect? That step is part of good money management strategy, and the humility of probably getting burnt way too many times for me to share with you on a show today. Thanks so much for joining me here today. I appreciate all the thoughtful questions, some great ones to put into the mailbag for the end of this week. Have a great evening. Happy birthday, Carrie. And remember, it's always a good time to own good charts. Have a good night, folks.